It was recently brought to my attention that NEOS, the company behind my favorite high-yielding dividend ETF, SPYI, just filed paperwork with the SEC to launch a brand new fund that's based off SPYI. A couple of weeks ago, this company notified the SEC that they would be launching a brand new ETF that basically has the goal of giving SPYI a much higher dividend. What you're looking at is Form N-1A, which was filed on September 3rd of this year and provides some of the information on what we can expect from this brand new ETF. So in this Patreon requested video, we're going to take a look at what's inside of this document and try and figure out what we can expect from this brand new NEOS ETF that's coming out. So this new fund that's coming out will be called the NEOS Boosted S&P 500 High Income ETF. There's no ticker symbol provided in this document, so we can only assume that they're still trying to pick what they'll use based upon what's still available. It'll probably still have SPY in its ticker symbol, but there aren't too many options available for a fourth letter. Maybe SPYO or SPYE, which are both still available. It's important to note that this is all preliminary information. It says, the information in this prospectus is not complete and may be changed. We may not sell these securities until the registration statement filed with the Securities and Exchange Commission is effective. This prospectus is not an offer to sell these securities and is not soliciting an offer to buy these securities in any state where the offer or sale is not permitted. This means that any of this information could be changed in the future. It could also mean NEOS could potentially change their mind about launching this ETF, although I highly doubt it. The fund this ETF is based on has been excellent. When I first bought into SPYI, it was less than a year old, but I was really confident in SPYI based upon what I was reading as well as the performance of it up to that point. It's offered a very dependable yield of between 12 and 13% with monthly distributions, and it's also done pretty well at recovering from market declines. The ultimate test for SPYI came when Trump announced his tariffs back in February. That sent the markets down hard in a pretty short amount of time, and SPYI had never gone through a test like that before. Because it is a covered call ETF, we all know that upside is going to be capped. So the question we were asking was, would SPYI recover? And fortunately, it did pass the test, unlike other similar CC funds like ticker XYLD. Other high-income investors have also seen the appeal of it, as it currently has over $5.5 billion in assets under management. So by all accounts, SPYI has been a massive hit for this tiny fund provider. And by the way, I've never been sponsored by this company, I've just been really pleased with their investments as you can see. So the fact that we're basically getting a new SPYI with an even higher yield is definitely worth investigating. Let's keep going through their N-1A filing. We can see it also doesn't provide an expense ratio at this point either, which isn't unusual at this particular point. But I'm assuming it'll be around the typical range for a NEOS ETF. But now going to the principal investment strategies of the fund, we can see how this ETF will function. It starts off by describing what SPYI does already. It's an actively managed ETF that invests in a portfolio of stocks that make up the S&P 500 index and utilize a call option strategy to provide high monthly income, which primarily consists of written or sold call options on the referenced index, SPX call options. If we scroll down a little further, we can see that's where the real bread and butter is going to be. Boosted/leverage strategy for adding exposure to SPYI. This component of the fund strategy is designed to drive boosted or additional exposure to the underlying strategies of SPYI. Specifically, the fund generates additional long exposure to the S&P 500 utilizing a synthetic option strategy and generates additional income for the fund through a synthetic covered call strategy. The synthetic covered call strategy part is the most important thing in that paragraph. It now appears that NEOS is expanding more into synthetic covered call ETFs, which is what companies like YieldMax, Roundhill, and Granite Shares are most famous for. Going down further, it says, the fund's exposure to the underlying strategies of SPYI, combined with the boost from the additional long exposure to the S&P 500 through a synthetic option strategy and the additional income through a synthetic SPX call option strategy, is designed to create approximately 150% of notional portfolio exposure to SPYI. I'm naturally a little concerned whenever I see the word synthetic being used in a prospectus because it always entails a high amount of risk. Now, I've talked about it many times before, but if you're not too familiar, a synthetic covered call strategy involves using options to try and replicate share price movements of a specific holding or holdings without actually owning the holdings themselves. Many ETFs that exist that use a synthetic strategy suffer from really serious share price declines over time, as well as higher volatility. With that being said, they rarely make for good long-term buy and hold investments, as in something that you'd want to hold for decades. For those who love yield max funds, for example, most people will trade in and out of these ETFs on a pretty regular basis in order to try to avoid NAV erosion. However, this isn't the first NEOS fund to be released that uses a synthetic covered call strategy. Ticker BTCI, which is their Bitcoin high income ETF, also uses a synthetic strategy. And I did mention in my latest high yielding Bitcoin ETF video that BTCI actually is a pretty good ETF. So I do like a synthetic ETF that's by NEOS, because at least up to this point, when this company uses synthetic covered calls, they appear to do so a lot more conservatively. But the question we're all still waiting to see an answer to is, how will this ETF do during market downturns? It's not a perfect comparison, but maybe what might be the closest alternative to this new fund could be SDTY by YieldMax. This ETF uses a synthetic strategy on SPYI, which is what the new NEOS fund will ultimately do. If we look at the share price performance of it, you'll see it didn't survive Trump's tariffs back in April. Despite the S&P recovering from Liberation Day, SDTY has been lagging behind significantly. But this ETF does use a different option strategy than what the SPYI alternative will ultimately use, so there's a possibility it won't be this bad, and in fact, I'd be pretty surprised if it is this bad. Like I just mentioned, based upon what we've seen by NEOS and their synthetic funds that already exist, they appear to be more conservative, so I am excited to see how it'll do. I should also mention that SPYI isn't the only NEOS fund that's going to be getting a higher yielding alternative. As you might have guessed, QQQI, their NASDAQ 100 high income ETF, is also getting a dividend booster. In the same SEC filing, NEOS also submitted paperwork for what's going to be called the NEOS Boosted NASDAQ 100 high income ETF. Just like before, no ticker symbol yet and no expense ratio is provided. But based upon what I'm reading, it looks like it'll have the exact same strategy, meaning it'll also use synthetic covered calls. In my opinion, this ETF is going to be even riskier because the NASDAQ 100 is much less diversified when it comes to sector allocations and the number of holdings it has. Now, in terms of what their dividend yields are going to be, they actually provide a range for us. For the SPYI alternative, they estimate a dividend yield of between 15 and 18%. For QQQI, they estimate a range of 19 to 23%. That's definitely enticing given both funds' performances up to this point. But that's pretty much all the major information that we currently have. The only thing we can do now is wait for them to launch and observe how they'll do from a share price perspective. But let me know what you guys think. If you like SPYI or QQQI, then I'm sure you'll at the very least be willing to look into these new ETFs. Like I said, how they'll manage market declines is going to be the most important thing to look at, and that'll take months of observation. What's good is, it's also going to be easy to compare SPYI to its alternative to see how well it does at capturing upside. But feel free to share your opinions, and with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.